Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, my name is Louis. Welcome to another episode of On My Way to Wealth. This is episode 41. We're moving right along here. Thank you for tuning in. Today, I want to talk to you about the benefits of owning a home from a tax perspective. A lot of my clients usually ask me, hey, what tax benefits do I get from owning a home? So I want to dive right into it and tell you some of the things that you might benefit from as a homeowner. The first thing, before I even get into that, I want you to understand the concept of itemized deductions versus standard deduction. Now, I know a lot of you might have heard these terms thrown around before, so I want to dive a little deeper into them so that you get a really clear picture of what this means and how it affects you when you do own a home. So whenever you file your taxes at the end of the year, the IRS lets you take either a standard deduction amount or itemized deductions. And all that means is that you get to deduct a certain amount from your adjusted gross income in order to arrive at whatever your taxable income is. So to give you an example, for tax year 2020, the standard deduction for a married couple is $24,800. So that means that, for example, let's say that this married couple made $100,000. Their adjusted gross income was $100,000. So we can deduct $24,800 from that $100,000. So that means that their taxable income is $75,200. No questions asked. This is a standard amount that the IRS lets you take without asking you for any receipts or anything like that. So this is a great way for people to just take the standard deduction. It's easy because you just take the number that the IRS gives you as a standard deduction. There's no record keeping requirement. There's no proof of any receipts or anything like that. So if you don't have a lot of itemized deductions, which I will explain shortly, then you really don't have to worry about keeping track of receipts and things like that. You just take the standard deduction and run with it. Now, there are instances where it may make more sense for you to itemize your deductions because your itemized deductions might end up being a larger number than your standard deduction number. So in the case of the $100,000 couple, if their itemized deductions end up being $32,000, for example, it's a much bigger number than $24,800, which means that their taxable income will be $68,000. So you want to take the bigger number of the standard deduction or the itemized deduction. And you get to do this every year. So there might be years when you take the standard deduction, there might be years when you take the itemized deduction, depending on what's going on in your lives. So let me tell you some of the most common things that you can itemize. Since we're talking about home ownership, typically property taxes are one of the things that can be itemized. Usually you would use Schedule A on your tax return. Property taxes, mortgage interest are things that you can itemize. Also things like charitable contributions. If you have medical expenses over a certain percentage of your income, can also be itemized. So since we're talking about property taxes here, one thing that has changed is as a result of the Tax Cuts and Jobs Act, you could no longer just itemize every single dollar that you paid towards your property taxes. In fact, there is a $10,000 cap for a married couple on what they call the SALT tax, which is state and local tax. So the acronym is SALT. People call it the SALT tax, state and local tax. So all that means is that, for example, people that live in high income tax states like New York and California, they were able to combine their state income taxes that they paid during the year. So let's say a couple paid $25,000 between state income tax and property taxes. They were able to use that as an itemized deduction. And then on top of that, throw in the mortgage interest, charitable contributions, et cetera. So you were able to significantly reduce your taxable income by combining all those things because that number would be higher than the standard deduction amount. Now, as a result of the Tax Cuts and Jobs Act, the state and local tax for a married couple in this case will be limited to $10,000. So that means that even if you had $40,000 in deductions in terms of your property taxes and state income taxes, you're still capped at that $10,000 figure. So some of the benefits of owning a home from a tax perspective are not as significant anymore because people that live in those high income states may already be paying over $10,000 in state income tax anyway. So having the additional expense of property taxes will no longer provide a tax benefit for owning that home. Now, mortgage interest can still be used as itemized deductions, but when you have the $10,000 cap on the SALT tax, the overall deduction is not going to be as large. So one thing you need to take into account, if it makes sense from a tax perspective, is having an idea of what the interest that you're going to pay every year is. So if, for example, you do not own a home yet and you're thinking, hey, if I buy a house, I might get a bigger tax deduction. Well, that may not be the case. So to give you an example, in my case, I live in the state of Nevada. In Las Vegas, you can still buy a $250,000 house. And interest rates are very low. So let's say somebody purchased a $250,000 house. They put, say, a 5% down payment. So their loan amount is $237,500. Let's say they got 3% interest rate. That's $7,125. So I multiplied the loan amount by the interest rate. This is just to give you a general figure. Well, if they lived in that property for the entire year and made mortgage payments for that year, so at the end of the year, they would only have $7,125 in mortgage interest. Let's say their property taxes was $2,500. Now they only have $9,625 of itemized deductions. So unless they are super charitable or had significant amount of other expenses like medical, et cetera, they might not reach that $24,800 figure that is provided by the IRS as a standard deduction. So in this particular case, owning a home did not make any difference as far as the tax situation of that couple. You know, they could have rented and still got the $24,800 of the standard deduction. So that's one thing that you definitely want to sit down your accountant or financial planner and see if, in fact, owning a home is going to give you more of a tax deduction at the end of the year. Because depending on where you live, it may not, you know, especially if you don't have any other itemized deductions like medical expenses and charitable contributions. So something to consider there. Now, that doesn't mean that there aren't any other tax benefits to owning a home. The immediate tax benefit at the end of the year when you file a tax return is just one of them. Another thing that you could potentially receive as a deduction when you own a home is if you have any renovating expenses as a result of any medical diagnosis. So if some people do itemize their taxes, there are some guidelines still within that, so make sure to speak to your accountant. But technically, if you have some home improvements that you needed to do as a result of a medical diagnosis, you might be able to take those expenses and use them as itemized deductions. So that particular year, maybe it might make sense to itemize. Now, you can also get tax credits if you own a home and you do certain energy improvements. So that's something else that you want to speak to your accountant about, because if, for example, if you get solar panels and things of that sort, you might be able to get a credit. Perhaps your state might also have a credit. So that could be another tax benefit from owning a home. And then the other one that might be a benefit long-term is when you go to sell the house. I get this question a lot, particularly when it comes to home improvements. A lot of people ask me, well, what if I improve my house? Now, can I deduct any of that? And immediately for that year, the answer is generally no. You know, if you have a primary residence and you spend $10,000 in home improvements, you do not get any tax benefit that year for improving that home. But to give you an example, what it does is that it increases what's called the cost basis of that house. And all that means is your investment in the house. So in my example earlier, if you purchase a house for $250,000, but then you make $10,000 in improvements over the years, your cost basis is actually $260,000. So the IRS takes into account your initial purchase of the house, plus any improvements you made throughout the years when you go sell to see if any of that gain is considered a taxable capital gain. Now, here's the thing I wanted to talk to you about. This is super important, which is another great benefit of owning a home. If you own a primary residence and you lived in it 2 out of the past 5 years, say you are single, you get to exclude $250,000 of any gain that you might have had. If you're a married couple, you get to sell for up to a $500,000 profit with zero taxes due. So in my example earlier, you purchase a home for $250,000. Let's say you held it for 5 years. The real estate market did excellent in your area, and you sold the house for $650,000, and you're a married couple and you lived in it for at least 2 out of the past 5 years. Well, you have a $400,000 gain that you pay zero income taxes on. So that is a tax benefit that you don't see immediately from a year to year basis when you're filing your taxes. But in the long term, it really helps you out when you go sell. So that is something that you want to speak to your accountant or financial planner about too, because it can help you with planning. If you're thinking about maybe downsizing, et cetera, it might make sense to do so when you're not going to pay any capital gains, or if you have a lower income tax year, so your capital gains are lower, or maybe even zero, right? So that's another great benefit of owning a home. So I just wanted to cover just those top three, make sure that you understood itemized deductions versus standard deduction, because sometimes, as a little recap here, owning a home may not necessarily give you an immediate tax benefit, because sometimes the standard deduction might make more sense to do, even if you are in fact paying property taxes and mortgage interest. And keep in mind that there are some tax credits that you could potentially get for making either home improvements based on a medical need, or if you have any energy efficient upgrades that you do. And then the final thing was, there is an exemption when you sell your primary residence if you have the requirements met, which are your primary residence and living in the house 2 out of the past 5 years. So I hope this helps clarify some of the tax credits and tax deductions that are available as part of being a homeowner. If you have any questions, feel free to send me an email at luis@onmywaytowealth.com. If you have any topics that you'd like for me to cover in the future, or anybody that you'd like me to interview, please send me an email as well, and I'll be happy to do that. So thank you very much for tuning in, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.